Welcome, sir. It's indeed an honor to be sharing the dais with you. And thank you, Raju, for those, I think I would say, a very, very powerful introduction. Thanks a lot. Deserving, otherwise, only time is going to say. And welcome, one and all, from the professional fraternity. It's indeed an exciting time. As we always say, anything new which comes up, that element of fascination is always there. And as professionals, I hope even if we are, whether you are representing industry or a practicing professional, we should definitely welcome change, because if things are going to remain constant, we become redundant to our clients. So the more dynamic the law is, definitely the role for us, one from a client perspective, definitely is important, and it also keeps us exciting. Ultimately, we feed on intellectual, I would say, inputs. Now, to start off with, what is the essence under the New Companies Act? As our director was mentioning, under the present income tax law as well, we have this concept of separate legal entity. Though by and large, it is not being adopted to a very large extent. Which is why the deemed dividend under 222E, the notorious section in terms of you not being able to withdraw funds from your own company. Now, what is the differentiation? If a person runs a partnership firm, you are a partner in a partnership firm holding 50%. Your firm has got some cash balance. Can you withdraw the funds? Yes. Will there be a tax implication on such withdrawal? No. Okay. If you are a private limited company, can you withdraw these funds? Yes or no? Definitely not. You can withdraw, but it will be subjected to dividend distribution. There is a tax on that. Now, dividend distribution tax is a put off, because obviously it's a post-tax money. On top of the sum being a post-tax income, you're supposed to pay an additional distribution sum, which is where people are finding their own ways and means of doing what is called as taking loan, making payments on behalf of promoters or their extended families, as they may call it. To curb such practices, we had the instance of 222E coming into picture. Now again, what is the rationale for 222E? A shareholder is different from the company which he owns. Now similarly, when we get into the New Companies Act, invariably most of the provisions in spirit as well as in letter is now envisaging or promoting this fundamental concept. If you own a company, you as an individual and your company as an entity are two separate persons. The agenda for the day, at least for the next half an hour, what we have at our disposal, is to highlight some of the interesting aspects of this New Companies Act on our income tax law. Now, when we get into our income tax law, what we thought was, we just thought we will look at some very specific provisions which will have an impact, and especially when we get into the mandatory CSR and other specific provisions. Now, look at the case of cross-border merger. Now, the New Companies Act has got a provision where an Indian company can get merged into a foreign entity. Look at a case, let's look at Hindustan Lever. Now, Unilever is an entity based out of UK, and you have Hindustan Lever in India. Now, if Unilever wants to absorb Hindustan Lever, merge it into its own books, and treat Hindustan Lever India as a branch of Unilever UK. Now look at the scenario. You have a UK company which is now picking up an Indian entity. Will there be a capital gain impact in this transaction? Yes? Yes. Why would you say that? Why would you say there is a capital gain impact in this transaction? Pardon me? As of now, both are different entities. Perfect. So what is getting transferred here, sir? Okay, so you are shifting your assets, as you rightly said, you are shifting your assets from India, which were thus far owned by an Indian entity, to an entity which is located in UK. So there's a transfer here. Perfect. Now, what is the other aspect of transfer which happens? Situs of the property in India. Now, when we say property, what are we trying to say? Is it the movable and immovable assets of the company, or is it something else? The ownership of the assets. From whom does it move, sir? From an Indian company to a foreign company. Again, there's one more asset which gets transferred. What is it? Yes, shares. Perfect. So the shareholders of this Indian entity will now do what? They will surrender their shares in return for shares in the UK entity. So the implication under this circumstance is twofold. One, you have an implication from a shareholder's perspective, the other from a company's perspective. Let's now look at the simpler one. Let's start out with the shareholder's perspective. Now here, let's assume you are a shareholder in Hindustan Lever, which is a listed entity. This entity gets merged into a foreign entity. You surrender. Is the act of surrender or exchange an event of transfer? Yes. Under section 2 subsection 47, this sale, exchange, relinquishment, extinguishment also becomes an instance of transfer. So the act of exchange of your Indian shares for shares in the foreign company is an instance of transfer. Now when there is an instance of transfer, you need two items to determine your capital gain. What are those? Cost of acquisition as well as sale consideration. Now what is the sale consideration in this circumstance? The current value of the foreign shares. Now here comes an issue, sir. Now here you are getting shares of a foreign company pre-merger. Post-merger, the valuation of these shares could be completely different. Now which value will you adopt? Will you take the pre-merger value or post-merger value? Post-merger value. But when are you receiving the shares? Pre-merger or post-merger? Will you sell? Now look at it. This actually happens in tandem. It is during merger. Ideally, it is not pre, effectively if you notice, it's neither pre nor post, it is during merger. Now when this merger happens, you sell your shares of, you would submit your shares of Hindustan Lever in India and receive shares of Unilever in UK. And consequent to this transaction, the assets also gets moved from the Indian entity to the foreign entity. Now the first ambiguity is which one will you take? If you see your current income tax law, it talks about domestic amalgamation, it talks about domestic demerger, which are eligible for exemption under income tax law. Currently, if you notice, an Indian company gets merged with an Indian company. The transaction, as long as it fulfills the conditions of Income Tax Act, is not a liable transaction for the purpose of taxation. We have a section called section 47, which talks about transactions which are not regarded as transfer. 47 subsection 7 says, during the course of merger, if a shareholder receives only shares as a consideration, there is no event of transfer, as long as the consideration is discharged only by means of shares. Now let's look at the case, an instance of what happened in the case of ArcelorMittal. Now in this case, Mittal Steel picked up Arcelor, an entity which was much bigger, and every time there was a resistance, what he did, apart from share swap, he was also offering some cash component. One of the most prized transactions which happened in the world. We must feel proud because it was done by an Indian, a person of Indian origin. He not necessarily be an Indian citizen, but in such a case, there was a share plus a cash component. Now the first ambiguity is, company law promotes Indian companies from being absorbed into a foreign entity, which is a very good thing, because you would again start expecting more foreign direct investments. Instead of investing into an Indian company, they will pick up an Indian company, they will get merged. Now what is the advantage? What is the advantage for a foreigner to buy, instead of buying shares into an Indian company, instead of vis-a-vis merging an Indian company into a foreign entity? What are the advantages? You can immediately start, but that he can always do. Let's say you are running an Indian entity, sir. Now you are running Hindustan Lever, you own the shares of Hindustan Lever in India. Now instead of Hindustan Lever Unilever buying you out, merging your company, he can buy your shares. He can still continue your own business. But what is the advantage of this? Strategic alignment. Perfect, sir. Can you please explain on that? Huh. So what will be the position of that company in India, of the merged entity? Perfect. It will be a branch of a foreign company. That gives you tremendous strategic advantage. The branch of a foreign company vis-a-vis an Indian entity, when you look at, first what you don't have dividend distribution tax. Section 115O does not apply to a foreign company. That's the first advantage. Second instance, you always have the protection of a treaty shelter. Now can you use a treaty? Let's say this foreign entity is now repatriating profits from India. It's transferring profits from the branch profits which it has earned in India to its foreign head office. Is there an instance of taxation in this case? There will be a 40% income tax, but the profit which gets transferred from India to abroad, is there a tax here? There was a levy contemplated under the direct taxes code. We had this concept called branch profits tax. Fortunately or unfortunately, the code is still yet to see the light. In case it comes, you never know. That's another potential hit. So as we speak now, this is a strategic advantage which people can have. You convert an Indian entity into a branch of a foreign company. Transfers happen far easily compared to what it would otherwise be. And instead of infusing capital in India, see, apart from the regular tax and regulatory the Companies Act perspective, look at the advantage it can have. Now, today, when you want to bring in FDI, FCCPR, company secretaries know it better than CS, taking it out. Now, what is the way of taking this capital out? If a foreigner has invested money, how can he take this money out? Now, invariably, if you notice, Indian money used to come from, there's a study which says 60% of India's money comes from Cyprus and Mauritius. Your FDI comes from Cyprus and Mauritius. So people were taking these funds out by way of buyback. Because based on the treaty which India has signed with these jurisdictions, capital gains will not be taxable on transfer of shares in India, but it gets taxed in the country in which the shareholder is a resident of. So if he is a resident of a place like Mauritius, Mauritius does not exempt capital gains tax. It says capital gains tax is taxed at 0%. Like your I think indirect taxes you call it as zero rated items. So under such circumstances, what happens? You would make money here, you will not distribute dividends, you will take the money out in the form of buyback, there is no capital gains tax. Recently, last year, 115. That's what, last year, 115 QA was introduced. Now we introduced no buyback tax. So they don't call it as dividend distribution tax, they call it as additional income tax. See, we are yet to see, because if you notice, at least with treaty jurisdictions, most of the countries with which India has signed, there is this concept called non-discriminate clause. Non-discriminate clause, where where a non-resident cannot be treated in a manner which is more unfavorable vis-a-vis a resident. Now, when you look at a buyback taxation, it applies to entities, typically which comes under the 115O category. So therefore, a non-resident is also outside the ambit of buyback taxation. So now, when you come back, the advantages, apart from the fact that you become a non-resident in India, when you become a non-resident in India, only your Indian income is taxable. Your foreign income is not taxable in India. It gets taxable in the country of your origin. The concern here is, we still do not have a provision for exemption here. Because under section 47, we talk about Indian mergers. We talk about shares held in an Indian entity owned by the amalgamating foreign company transferred to the amalgamated foreign company. Look at the same instance. Unilever is in UK. Let's say Procter & Gamble is also based out of UK. Unilever holds Hindustan Lever in India. Now Unilever gets merged into Procter & Gamble. Now here there is a transfer of assets. What is the asset here? What is the asset which is getting transferred? Shares of an Indian company which are held by a non-resident foreign company which gets transferred from the amalgamating foreign company to the amalgamated foreign company. This transaction is eligible for exemption under 47(6)(a). We do have a provision under law for that. But however, when it comes to an Indian entity getting merged into a foreign company, which is currently allowed under the new Companies Act, this position in terms of exemption is not available. But still, we do have enormous amounts of strategic advantages. One, FEMA compliance to a large extent is lower for a foreign resident. Most of the FEMA compliance talks about resident transactions. If a resident is going to have a forex transaction, we are not bothered when a non-resident is going to send money from Singapore to Dubai. It's not going to hit you. But if a resident and a person resident in India, if he's got a bank account in Dubai and he sends it to Singapore, there is an issue. There are compliance issues. An Indian entity having a subsidiary overseas, if you have a subsidiary in Indonesia, you are supposed to report that. And as per FEMA's, RBI has jurisdiction to request for such information of your subsidiary in Indonesia. All these provisions are now weeded out by virtue of this cross-border amalgamation. And of course, your buyback taxation to a large extent will also not apply, because there is no concept of buyback here. You will still hold shares only in the foreign entity. The only thing which you will repatriate is the profits, post-tax profits from India. We still do not have a branch profit tax possibility. If under the new Companies Act, when they are going to look at this as a serious proposition, we can have the provisions which we thought will come under DTC under the Companies Act, under the Income Tax Act as well. The next issue, your corporate social responsibility. There is this 2% of average net profits of 3 immediately preceding previous years. I'm not getting into the computation part or the technical part.